Well, it is a big day, our first day here on Risk and Reward. It's fitting that we bring in the person running the biggest parts of the biggest alt asset firm in the world, John Gray, head of global real estate. John, welcome. Thank you so much for being here.
Thanks for having me. Congrats on your new program.
Thank you very much. Before we talk about real estate, which is why you're here, I just want to ask you about trust in the financial system. This is trust and confidence, the two pegs that basically make this whole thing work.
Well, look, I think it's critically important that there is trust in the financial system. As our firm, we think that is paramount, operating with integrity, and I think it's true for everybody because we need institutional and retail investors to have confidence.
And with that in mind, I mean, part of your reputation is built on 2007. You were probably, arguably, the only disciplined person out there in real estate, which does speak to the franchise you have now. What are you doing now? Where are you seeing value now that perhaps others aren't?
Well, I would say today Europe is one place where we're seeing more value because of the distress that exists in the system. Obviously, the European financial system has some serious challenges today, and growth is challenged. But there's also a lot of assets that are up for sale at prices that seem attractive to us. So if you look in places like Spain and Italy, prices have fallen quite a bit. We're buying shopping centers, we're buying residential properties at half or less than what we saw in the past.
So is the idea here that higher returns slump the slower growth that people have seen in the region?
Yes, I would say that oftentimes as investors, people think I want to buy something that's growing quickly, but it's not just the growth, it's also the price you have to pay for that. And I would say that in Europe in particular, the growth is not great, but the pricing, the distressed asset pricing, has proven to be pretty attractive.
And you've just closed a €5 billion fund. I know you raised that money in 6 months. That's incredibly quick. So, I mean, the demand is out there.
The demand is there, although I think you need experience to do it. Europe is tricky because of the nature of the economies there. You're dealing with a lot of different jurisdictions. You need expertise. You need people who speak different languages. I think our investors, because of the track record we've had, the solid performance, this is our fourth European real estate fund, they were looking for somebody they could have confidence with to invest in a tricky market like Europe.
Is it mostly distressed that you're interested in there?
In Europe in particular, I would say there's more of a focus on distress, certainly because of what they went through. They're essentially going through the financial crisis like we did just a few years later. And the net result of that is there's more assets there that you can buy, more debt you can buy. That sort of distress no longer exists in the same way in the U.S. today.
All right. Well, I was just going to say, where are you finding value then here in the U.S.?
So in the U.S., there are a couple places. We have been actively buying in the U.S. housing business, which I'm sure people are interested in hearing about. And there, that market's been a little bit slower to recover relative to the commercial real estate. We've seen prices decline 50% in some of the more distressed markets. We begin to see prices come back up, but I still think there's a ways to go in that market. And the reason why is new supply. People have seen that new supply of homes has gone from, call it, 1.3 million on average for 15 years prior to the crisis to around 500,000 today in the last 5 years. And there's really been a shortage of new construction. That shortage of new construction has meant that there's been an opportunity to see values grow faster. So we found housing attractive.
What do you think about this idea that rates will, at least if we listen to Janet Yellen, will be higher before year's ends?
As it relates to residential, which I just touched on, it's interesting. If you look back over the last 50 years, U.S. interest rates went up 26 times. All 26 times that happened, prices of homes went up. So economic growth has proven to be more important than just the level of interest rates. And it's true in commercial real estate as well. If you look back to the early 90s, if you looked at the late 90s, if you looked at the mid-2000s, what you'd see in all of those situations is that values went up despite interest rates going up. So we take a little bit of a longer term view, not just what's going to happen in the short term. And we generally think supply demand argues that value goes up further in commercial and residential real estate.
John, some people may or may not know, I mean, Blackstone is the largest landlord in the U.S., mostly through Invitation Homes. I know it's more than 40,000 properties, as you mentioned. Timing of an exit, I mean, would you exit as a REIT? Do you have a sense of when it's time to leave that?
Well, I would say what we'd like to do is to manage this as effectively as possible. So we've been buying post-foreclosed homes. Although 40,000 sounds like a lot, there are 130 million housing units, so it's still pretty small in the scheme of the overall market. What we'd like to do is complete the mission. We have a business where we want to buy things, fix it, and then ultimately sell. And in this case, the fixing part comes from renovating the homes, leasing them up, and then when it's a stabilized business where we're providing great quality service to the underlying tenants, we'll look at some sort of exit. I would expect over the next couple of years, the public markets is probably the most likely form of exit.
Okay, but in the meantime, it's going to take a little bit more time. John, stay with me, please. We will continue our conversation with John Gray. Well, we are back, as promised, with Jonathan Gray. He is the head of real estate at Blackstone. So, John, we were just talking about the U.S. You are the largest landlord, for people who don't know, and the largest hotel company. When do you call the top of the market?
Well, the top of the market looks a lot different than what we're seeing today. The top of the market typically in real estate is characterized by too much capital, meaning too much lending, or too much in the way of cranes. And when you look outside your window and you see shopping centers, office buildings, hotels everywhere being built. And if you drive around this country, you generally don't see that. In fact, new levels of supply are pretty low. You don't see banks lending 90-95% as they were back in that 05 to 07 period. So I still think we have a couple more pretty good years in the commercial real estate market. It's not the deep distress phase we were in 2009-11 when things were very, very attractively priced. On the other hand, we're not near any sort of bubble or frothiness today.
All right, I want to focus a little bit on hotels because you have Hilton, you own 68% of it. Is there more to do there?
With Hilton specifically, yeah. I think it's a great business and a great long-term business. If you think about global travel, demand for hotel rooms, it grows, particularly international travel, at more than twice the rate of GDP. And we're in the early stages. If you think about it, in the United States, Hilton has 3,000 hotels. In China, when we acquired the company back in 07, it had 3. Today, or in the next couple of years, it'll be 150. 150 relative to the 3,000 in the U.S. means huge opportunity. Chris Nassetta, the CEO, is really pushing to grow the company globally. And the recovery in the U.S. will also lead to more growth here.
And I know La Quinta just priced, so we can't talk about that. But what do you make of a company like Airbnb, $10 billion valuation? Do you consider that disruptive to La Quinta, to Hilton, to any of the other hotel properties you have?
Well, I think what the folks at Airbnb have done is very creative. I don't believe it fundamentally changes the hotel business. I think there could be some portion of market share that goes that way, but long term, I think customers are looking for consistency. Many of the amenities, services, frequency programs that are offered by the big hotel companies, so I don't think it changes the long-term prognosis.
All right, I don't know, John, because especially in New York, you know, it's like $1 gazillion to say you can go stay in someone's apartment, although that said, you never quite know how many dogs or cats or other creatures have been there before, so something to keep in mind, which probably you don't worry about in a hotel room. Going from the U.S. to China, I know that you've been very active in Asia. There's a lot of people talking about a Chinese debt bubble. How much of that do you think is a possibility, or do you already see one?
I think there's a lot of near-term negativity around China as its growth slows. But we've got to keep it in mind in context, which is China's still growing at greater than 7% versus here in this country 2.5%. Great infrastructure in the country, pro-business environment, still a low-cost place to do business, and a very hard-working culture. And I know we as a firm are very positive about China long term. And when people get quite negative about a place, we talked earlier about Europe, emerging markets, China in particular, that's happening, it begins to create investment opportunities. So for us, we just bought control of a large shopping mall company in China. And despite all the headlines you read that are negative, same-store sales last year grew 17%. China is going to grow more slowly, but I think the market's more than discounting that, and I think that creates opportunity for long-term capital.
As far as creating opportunity, we talked about the U.S., we talked about Europe, talking about China. You are obviously the biggest player in the space. Does being big ever hurt you? Are you as nimble as you want to be?
For us, given the scale of global real estate, it's a $30 trillion business. Our $80 billion of assets, or of equity, $130 billion of assets sounds big, but it's still small relative to the overall investable universe. And what we find is having large discretionary capital, large amounts of discretionary capital our investors gives us a real advantage. Plus, having teams on the ground, we've got 300 people around the globe in 8 different offices. It allows us to move and take advantage of opportunities. Actually, scale allows us to see, I think, better relative value and move more quickly and take advantage of global relationships. Real estate's really moved from being a local business to a national to now, I think, really a global business, and being the leading global player we see as a real advantage, not a negative.
All right, so you've never tried to be in a deal and you think, I actually have too much cash to use.
We don't find that. In the public markets, I know there's that concern as managers get so big, their returns go down. If you look at our history, our returns have actually gone up on a relative basis as we've gone bigger. Having discretionary capital, offering sellers certainty in a world where there's not a lot of certainty is a big advantage. We talked about housing. In housing, we didn't need to rely on the banks because we had that capital. So we found size to be a real advantage.
John Gray, thank you very much. Thanking you very much as well for kicking off Risk and Reward in good style. Thanks very much, John Gray, joining us there, head of global real estate at Blackstone.